Okay, so you're seeing these headlines, right? Everybody's kind of looking at their 401ks and thinking, uh-oh, what's going on? All this talk about tariffs and market drops and recession, it can get pretty overwhelming, right? I mean, whether you're just starting out or you've been saving for years, it's your future we're talking about here.
Yeah, absolutely. And I think you hit the nail on the head there. It's about your future. And what we're seeing right now is a real clash between, the long game, saving for retirement, and the immediate anxieties, like what is happening in the market today. We've got two really interesting pieces of information to work with today. One that goes back to basics, like what even is a 401k, and another that's diving into the current market situation, all this downturn talk linked to the new tariffs, and then what experts are actually recommending people do about it.
Yeah, and it's a lot to process, right? I mean, so many people are feeling lost and confused, and that's what we're here to do today. Cut through that noise. We're going to give you a clear picture of how 401ks actually work, what's really going on in the market, and most importantly, some concrete steps you can take to feel more in control of your retirement savings. No more feeling lost in the jargon or just totally freaked out about every headline, right?
Exactly. Let's do it.
All right, so let's get back to basics. For someone who maybe is just starting out or just needs a refresher, what is a 401k exactly?
So a 401k is basically a retirement savings and investment plan, and it's offered by a lot of employers. The name 401k actually comes from a section of the U.S. tax code, but don't let that scare you. Think of it as a special savings account just for your retirement. The difference is this account comes with some really attractive perks.
Okay, perks. We like perks, right? So how does this special retirement account actually work in practice? Like, what does it look like for someone who's participating?
Sure. So usually your employer will have certain times of the year when you can enroll in the plan. You choose if you want to join, and we strongly recommend you do, and then you decide how much you want to contribute from each paycheck. Now, a key point here is you can generally contribute pre-tax dollars, which is what a traditional 401k is all about, or after-tax dollars, which go into a Roth 401k. More on those in a minute. But for now, just know the chosen amount is taken right out of your pay automatically and put into your 401k account.
Got it. So it's like automatic savings. That's cool. But the money doesn't just sit there, right?
No, not at all.
Ah.
Your employer's plan will offer you a bunch of investment options. Now, these are often mutual funds, which you can think of as like baskets of different investments like stocks and bonds. It's like a pre-made, diversified portfolio managed by professionals, so you don't have to go picking individual stocks and things. And this is where it gets interesting. You decide how your money is spread across these different options. Do you want more in stocks, which represent ownership in companies, or more in bonds, which are basically loans you're making to governments or corporations? It all depends on your comfort with risk and how long you have until retirement. If you're younger, maybe you go for more stocks because you have time to ride out any ups and downs. Closer to retirement, maybe you shift more towards bonds for a bit more stability.
Taxes stressing you out? Don't worry, 1-800-ACCOUNTANT is here. Expert help, affordable rates. Call 1-800-ACCOUNTANT today and leave the headaches to the tax pros. Click the link below.
Right, that makes sense, like playing it a little safer as you get closer to needing that money. But so I'm putting money in, it's getting invested. How does it actually grow over time?
So the goal here is for your investments to increase in value, right? And there are two main ways that happens. The first is capital appreciation, which is just a fancy way of saying the price of your investments goes up like a stock or a mutual fund becoming more valuable. The second way is through something called reinvested earnings. So some stocks, some mutual funds, they pay out dividends, which are essentially a portion of the company's profits. In a 401k, these dividends are often automatically reinvested. That means they buy you more shares and potentially generate even more growth. Then once you hit retirement age, usually around 59.5, you can start taking that money out. Now, the question of whether those withdrawals are taxed depends on whether you chose the traditional or Roth 401k route. With a traditional 401k, your withdrawals in retirement are generally taxed as ordinary income. But with a Roth 401k, if you've met certain requirements, those qualified withdrawals you make are completely tax-free.
Okay, so we need to talk about those tax advantages because that sounds like a pretty big deal.
It is, absolutely. I mean, it's one of the biggest reasons why 401ks are so popular. With the traditional 401k, you're actually reducing your taxable income now in the present because your contributions are pre-tax. So right off the bat, you're paying less in taxes the year you make those contributions. And here's the even cooler part. All that growth on those investments, all those increases in value, those dividends, they aren't taxed until you withdraw that money in retirement. That's what's called tax-deferred growth.
Wow, so you're pushing that tax bill way down the road. Now, how's the Roth 401k different in terms of taxes?
So with a Roth, it's like the reverse. You're making your contributions with money that's already been taxed after tax dollars. But the magic of the Roth is this. Since you've already paid those taxes up front, all that growth that happens over the years and any qualified withdrawals you make in retirement are completely tax-free. That can be a huge benefit down the line, especially if you're in a higher tax bracket in retirement than you are right now.
That is a big difference. So how does someone decide, okay, is traditional better for me or should I go with a Roth?
It really depends on your individual situation, right?
Yeah.
Like what's your tax bracket now and what do you think it's going to look like in the future? If you think you'll be paying higher taxes in retirement than you are today, a Roth might be the way to go. You're paying those taxes now at a lower rate, but then all that future growth and those withdrawals are tax-free. On the other hand, if you really need a tax break right now, or if you expect to be in a lower tax bracket later on, the traditional 401k might make more sense. There's no one-size-fits-all answer. It's all about your personal financial forecast.
Makes sense. It's got to be tailored to you. Now, you mentioned those attractive perks earlier, and I think one of the biggest ones people talk about is the employer match. This is what people call free money, right? So break that down for us.
Yeah.
The employer match, free money, basically. A lot of employers will actually contribute to your 401k based on a percentage of what you put in. So let's say your employer matches 50% of your contributions up to the first 6% of your salary. If you contribute 6% of your paycheck, they'll throw in an extra 3%. It's basically an instant return on your investment, and it often beats even the best performing years in the market. I mean, it's as close to free money as you're going to get in the investing world. It can make a really big difference in how quickly your retirement savings grow over time. Honestly, most of the time it makes sense to contribute at least enough to get that full employer match. Otherwise, you're basically leaving free money on the table.
Yeah, it's like giving yourself a pay cut if you don't take that match. So just to recap all this, why should people really take advantage of their 401k? What are the key takeaways here?
All right, let's sum it up. Number one, tax advantages. Whether it's an immediate break with a traditional 401k or tax-free withdrawals later with a Roth, those benefits are huge. Number two, the employer match. Don't miss out on that free money, folks. Number three, it encourages disciplined saving. It's automatic. It comes right out of your paycheck. You don't have to think about it. And then there's the long-term growth potential. You're investing in a diversified mix of stocks and bonds, and historically, that's led to really solid returns over time. Plus, it's just convenient. It's right there, easy to access through your work. No need to go searching for a separate investment account. It makes saving for retirement a whole lot simpler.
Trade in your boring job for a brilliant career using Adobe Creative Cloud. Start learning now with the free trial link in the description.
Okay, so that's the 401k breakdown. Now we got to shift gears and talk about what's happening right now because things are a little rocky out there. We're seeing all these market swings and our sources are pointing to these new tariffs as a major factor. Can you help us understand what's going on?
Definitely. So we've seen a noticeable drop in the stock market lately. In fact, one of our sources says that trillions of dollars, trillions have been wiped out since the beginning of the year. And a huge chunk of that decline happened really recently, right around the same time these new tariffs were put into place.
Trillions. That's hard to even wrap your head around. And they're saying these tariffs are the main culprit here.
Yeah, it seems to be a primary driver. Experts always talk about how much markets hate uncertainty. And these new tariffs, the way they're being introduced, it's causing a ton of uncertainty. The levels, the calculations, the communication around them, how they're actually being implemented, it's all creating a lot of confusion, especially about global trade. And here's the key thing. It's impacting expectations about future corporate earnings. That's what really drives stock prices, the belief that companies are going to make money in the future. When there's this much uncertainty, investors get nervous, and that pushes those stock prices down.
So it's like a domino effect. The tariffs create instability, companies can't predict their profits as easily, investors get spooked, and stock prices fall.
Exactly. And this is not just some abstract idea. Even the CEO of BlackRock, one of the biggest investment firms out there, is saying that the stock market could drop even further, like another 20% because of these tariffs. And he's even talking about a possible recession as a direct result of all this. That's a pretty serious warning coming from someone like him.
Yeah, I'll say. So given all this turmoil, what are the experts telling people to do? What should people with a 401k be doing? Or more importantly, what should they not be doing right now?
The advice is actually really consistent across the board. Don't panic. Stay the course. And if you absolutely have to take money out of your retirement account, Only take what you need to cover your immediate expenses until things hopefully recover.
Don't panic. Easier said than done when you're watching your balance drop, right? But why is stay the course the go-to advice here?
Well, the experts point out that it's almost impossible to time the market perfectly. It's really hard to know exactly when the bottom is going to hit and when the recovery is going to start. If you try to sell low and then buy back in later, you could miss out on the rebound and actually end up losing money. The most important thing is to remember your long-term goals. Your 401k is for retirement. It's not a get-rich-quick scheme. These ups and downs are normal. They're part of the game. Historically, after every big drop, we've seen even bigger growth. The people who stayed invested are the ones who reaped those rewards.
That does make me feel a little better. Now, what about people who are getting closer to retirement? Say they're 5, 10 years out. Does the same advice apply, or do they need to be thinking about things a little differently?
Yeah, it's a bit more nuanced for them. The general recommendation is that as you get closer to retirement, you should start gradually shifting away from stocks as your primary investment. Instead, you want to increase your exposure to more stable things like bonds and other fixed income products. A lot of 401k plans offer these things called target date funds, which automatically adjust your portfolio as you get closer to your chosen retirement date, moving you more into those safer investments. They may not grow as fast as stocks, but they're also a lot less likely to take a big hit during a downturn. Like we saw recently, the S&P 500, which tracks 500 of the biggest companies in the U.S., dropped almost 10%. So as you get closer to retirement, it's about finding that balance between growth and protecting what you've already saved.
Makes sense. Okay, but what about people who are about to retire, like they're planning to tap into their 401k or an IRA, an individual retirement account very soon? What should they be doing?
For them, it might actually make sense to think about delaying retirement, even if it's just for a few months. That could give the market time to recover a bit, and then they'd be in a better position when they start taking withdrawals. Of course, this isn't always possible for everyone, but if they have the flexibility, it's something to consider.
Yeah, big decision. Now, the article we read also talked about how a lot of people treat their 401k like a savings account. They're contributing, which is great, but they're not really paying attention to what their money is actually invested in. How does that play out in a situation like this?
That's such an important point. A lot of people tend to just stick with what's worked in the past, and for a long time that's been stocks. But there's also a lot of inertia. People set up their 401k and then they just never really look at it again. They don't rebalance, they don't adjust their investments, and in a downturn, that can be really risky. They might be way more exposed to risk than they realize, or they might panic and sell everything at the worst possible time because they haven't really been engaged with their investments.
Oh yeah, that makes sense. Now, what about people who are already retired and they have to take those required minimum distributions, the RMDs, right? How does all this affect them?
Yeah, that's a big one for retirees. So anyone over 73 with a traditional 401k or IRA, the government requires them to withdraw a certain amount each year. And with the market down, some advisors are saying, hey, if you usually take your RMDs all at once, maybe wait till later in the year, see if things bounce back a bit. And then if the market's still down when you do have to take that money out, there's a strategy some experts call sell low, buy low. So you take your RMD, pay your taxes, but then you reinvest that money back into the market, maybe in a taxable brokerage account. If you think it's still undervalued, you're basically buying more shares at a lower price.
That's a really interesting way to look at it.
Yeah.
So what about people who are still years away from retirement? What's the message for them in all this craziness?
For them, the message is the simplest. Keep doing what you're doing. Keep contributing regularly to your 401k or IRA. Retirement is a marathon, not a sprint. The market goes up, it goes down, but over the long term, it's historically trended upwards. Plus, when the market's down like this, you're actually buying more shares of your investments at a discount. Think of it as a long-term buying opportunity.
Yeah, that's a much better way to think about it. Instead of freaking out, it's like, hey, I'm getting a good deal on my future retirement.
Right.
One last thing the article mentioned, and I think it's really important, the emotional side of all this. They talked about how important it is to talk to someone about your worries when the market's down. Why is that so important?
It's huge because investing isn't just about numbers, right? There's a big emotional component. Seeing your balance drop can be scary, and it can lead people to make rash decisions that might not be in their best interest in the long run. Talking to someone, whether it's a friend, a family member who's good with money, or a financial advisor, it can really help. They can give you support, offer a different perspective, help you stick to your plan. You don't have to go through this alone.
That's such good advice. It's easy to feel isolated when you're stressed about money, so let's bring it all home. What are the big takeaways from our deep dive into 401ks and navigating this volatile market?
Okay, big picture. Your 401k is still one of the best tools you have for building a secure retirement. Those tax advantages are huge, and don't forget about that employer match. It's like free money, you got to take it. Now, yeah, the market's being a bit crazy right now, a lot of it tied to these new tariffs. But for most people, especially if you're still years away from retirement, the best thing to do is just stay the course. Keep contributing regularly, and try to see these dips as buying opportunities. If you're closer to retirement, you might want to think about adjusting your investments a little bit. Make sure you're not taking on too much risk. And for those just about to retire, delaying if you can, even just a bit, might be a good move.
So much good info. As you're processing all of this, I want to leave you with one final thought. We know the market can be unpredictable, and retirement planning is a long game. So what are some things you can do to feel more in control of your financial future, no matter what happens in the short term? Maybe it's looking into how you can diversify your 401k even more, or maybe it's increasing your contributions while prices are lower, or maybe it's talking to a financial advisor to get a personalized plan that can weather any storm. Thanks for joining us on this deep dive.
Anytime.